Cryptocurrency markets are once again testing investor conviction. After months of optimism, we've seen a meaningful pullback across the board, one that has shaken out leverage, cooled sentiment, and reminded participants that volatility is not a bug of this asset class, but a feature. Yet history shows that moments like these often matter far more in hindsight than in real time. The latest market retracement has been sharp and uncomfortable. Bitcoin has slipped well off recent highs, dragging the broader market down with it, while altcoins have suffered even deeper drawdowns. XRP, like many large-cap digital assets, has seen significant short-term pain. But zooming out, this looks less like a structural breakdown and more like a reset within a broader cycle. Leverage had built up, expectations ran ahead of liquidity conditions, and macro realities finally caught up to price. In previous cycles, these kinds of pullbacks have often marked the transition from speculative excess back to accumulation, especially when they occur before the most explosive phase of a bull market. Bitcoin's 4-year cycle, anchored around halving events, has been one of the most consistent patterns in crypto. Historically, the largest upside tends to arrive after periods of consolidation and frustration, not during moments of peak enthusiasm. That said, this cycle is different in one key respect. Macroeconomics matters more than ever. Global liquidity, often proxied by M2 money supply, has expanded again, which is supportive for risk assets over time. However, that liquidity has not been unleashed as aggressively as markets once expected. The Federal Reserve has been far more cautious with rate cuts, choosing to move slowly despite earlier hopes for rapid easing. This slower-than-anticipated pace has tightened financial conditions and temporarily weighed on speculative assets like crypto. But it also suggests something important. When liquidity conditions do ease meaningfully, there may be far more upside left than the market currently prices in. Cycles don't disappear, they stretch. One of the most underappreciated catalysts for the next leg of crypto adoption is regulation. The Digital Asset Market Clarity Act has already passed the House and now sits in the Senate, where debate continues. While progress has been slower than many hoped, the direction is unmistakable. The U.S. is moving toward a clearer framework for digital assets. For institutional capital, clarity is oxygen. Whether it's custody, compliance, or classification, regulatory certainty removes friction. And historically, markets move before the headlines, not after them. If and when clarity arrives, it could fundamentally change how capital allocators view crypto. Not as a speculative sideshow, but as an emerging financial infrastructure. XRP and the Amazon of Web3 thesis. This is where XRP deserves a deeper look. Amazon did not dominate Web 1 because it was flashy or immediately profitable. In fact, Amazon stock went essentially nowhere for nearly 9 years. What it did have was infrastructure, vision, and positioning at the center of a technological shift. XRP has a similar opportunity in Web 3. Rather than competing for attention in meme-driven narratives, XRP is focused on plumbing, cross-border payments, liquidity provisioning, and interoperability between financial systems. If Web 3 fulfills even a fraction of its promise, value will accrue not just to applications but to the rails beneath them. Being early to infrastructure rarely feels exciting in the moment. It feels boring, slow, and often thankless, until suddenly it isn't. All investing ultimately comes down to risk versus reward. Crypto is volatile. XRP is no exception. But volatility alone does not define risk. Permanent loss does. When viewed through a long-term lens, XRP represents what many would call an asymmetric investment. The ability to allocate a relatively small amount of capital for exposure to disproportionately large upside. If XRP fails to achieve widespread adoption, the downside is defined and manageable. But if it succeeds, if it becomes a core piece of Web3 financial infrastructure, the upside is difficult to model. That is the essence of asymmetry. A $10, $15 XRP in the next bull run? Based on historical cycles, expanding liquidity, regulatory progress, and infrastructure adoption, a move to $10, $15 XRP during the next bull run is not an outlandish prediction. It is a scenario rooted in precedent, not fantasy. Markets don't move linearly. They move violently, emotionally, and often much further than logic would suggest, in both directions. The next bull run is still forthcoming. And when it arrives, today's fear may look eerily similar to past moments that, in hindsight, defined generational opportunities. Final thoughts. The road ahead for cryptocurrency will not be smooth. Pullbacks, doubt, and disbelief are part of the process. But innovation rarely announces itself with comfort. XRP doesn't need to win every narrative, it only needs to be there when the infrastructure matters, just like Amazon was. Visit moneystorm.com for all your crypto educational needs.